Good afternoon, Board of Directors and the Department Heads of Entrepreneurship Enterprise. Welcome to our webinar workshop, Succession 101, where you will be educated on how to improve your business succession strategy by our team of succession strategy specialists. My team and I will be focusing on 5 crucial areas of succession in a family business. The objectives we'd like to cover are 1. Detail the management succession strategy. 2. Explain the key factors in succession. 3. Develop a succession strategy. 4. Develop an exit strategy. And last but not least, explain how to complete the sale of a business. Before we get into the meat of the discussion, here are 3 different companies that have implemented the succession strategy. My colleague, Ms. Anderson, will educate you on management succession strategy, the importance, the required steps to the strategy, the barriers, and the reason your succession plan could fail if things aren't put in place with the aid of a diagram.
Good afternoon, class. My name is Claudian, and today I will be assessing the first objective, which is detail the management succession strategy. What is management succession strategy, one might ask? Management succession planning is a process of preparing an organization for a transition in leadership, identifying and developing new leaders who can replace old leaders when they leave, retire, or die. It increases the availability of experienced and capable employees that are prepared to assume these roles as they become available. What is the importance of succession strategy? Well, a succession planning program compiles the skills, ability, and goals of each employee, compares them to the needs of current and future roles, and tracks employee progress towards being ready to fulfill these roles. We now have an image showing the management succession diagram. It first identifies the position, then identify the skill needed, which we then later assess the persons vying for this position. We later develop a plan, after which we monitor it. And as you can see, it is a never-ending cycle. There's 5 steps to management succession. 1. You align plan with strategy. There must be a business plan. Also, you must have an idea where you want the business to be in the future, right? Step 2. Identify skills and competencies. With step 2 now, you assign persons here that match their expertise to enhance productivity, and that is something you want to do within your company. Step 3. Identify potential employees. You know, when replacing or even recruiting new candidates for a position, we always go for the persons who are qualified, most qualified to be exact for that position. Step 4. Provide developmental opportunities and experiences. With this now, this includes management development such as job rotation, promotions, mentoring, or even coaching to be exact. With step 5 now, you monitor the plan. Everything that has been listed above, you see that where they are implemented, they are being carried out. Barriers to succession planning. Today, we'll be assessing two components, owner and family. With owner barriers, there's debt anxiety, loss of company's identity, which is where the company is used as a symbol of achievement or maybe some form of accomplishment, and generational envy, where there's a loss of power, maybe from an older brother to a younger brother, or maybe the person who is in charge now to some other relative, some other distant relative, right? We also have family. This is where fear of loss or abandonment, or they might say death as a taboo in the family. Fear of sibling rivalry, where the older brother might not want to cause, the younger brother, may not want to cause some fuss with the older brother because he thinks the older brother is more capable of running the company, or he might have some other plans for his future, right? And change of spouse position, and you know that goes. Reasons for management succession plan failure. 1. Successor may leave. For example, he might have some other plan for his future and doesn't necessarily want to take over the business. 2. Incumbent does leave. This is where the person who is in charge now doesn't want to give up his position, right? 3. Successor doesn't perform, which is self-explanatory, right? 4. Succession planning is considered as an human resource management function. And 5, they focus on current and not future skills. Too often, management look in the rear view mirror to understand what the company needs for the road ahead. And that is the end of my presentation.
Pleasant good afternoon, Ms. Fairclough, and I'll be presenting on the key factors in succession. Before I jump into the discussion, I would like to give a few examples of family-owned businesses that are in Jamaica. So a few examples are Panjam Investment Limited, that is owned by the Facey family. You have the Honey Bun Company, that's owned by the Chung family. You have ICD, which stands for International Classification of Diseases. They're owned by the Matalan family. And you have Lasushan Supermarket and John Wang, which is owned by the Lasushan family. And the Sovereign Centers, that's owned by Gladstone and the Lasushan family. They are brothers. So these are just a few examples of privately owned family businesses in Jamaica. In the case of privately owned businesses, one of the most important things to note on the concept of smooth succession is that it requires both structural and cultural changes. Family businesses, like any business, has succession. Within the family business and the business family must be separated in order to achieve succession. Next, we will be moving on to the issues affecting succession. So there are two categories, right? There are internal pressures and interests, and there are external pressures and interests. For the internal pressures and interests, they happen inside the firm, right? So these include family members that are employees and also non-family employees. So under the heading family members as shown on the slide, in this case, some family members are employees of the business as mentioned before. So there are many conflicts that can arise, such as due to the fact that these family members will want to keep the business alive so that they can gain control over the business's operations. The second conflict that can arise is the pressure on the owner to choose an heir, which would lead to rivalry among family members regarding who will be the successor of the business. This could, however, lead to the sale of the business or bankruptcy, as only one family branch can be in charge of the operations of the firm. So the next point under the internal pressures and interests are non-family members who are employees. So they are non-family employees, as shown on the slide, right? So let's go again. So non-family employees also contribute to the firm's success, which makes this group very important. What they say or want matters as well as the family members who work for the firm, right? So these employees, they may ask to purchase shares of the company as to secure their position as employees in the firm, right? So in other terms, job security. So this indicates that the employees are invested and they are interested in the firm's growth, equity, and its succession. On to the next issue that affects succession, which are the external pressures and interests. So as discussed earlier, the internal pressures and interests, they are pressures from inside the firm. External pressures and interests by the name are pressures outside the firm, right? So the first point on the external pressures and interests are the relatives, right? So the relatives, they're only interested in the inheritance and the income of the company. So in some instances, these family members will put pressure on the owner of the company because of their interests. They would pressure the owner to hire them, but these requests can be denied by the owner on the grounds that the company does not need any additional personnel or they need an employee with specific skills that the relative obviously does not have. The next and final external pressure and interest are the competitors. So the competitors have a part to play in the approach a firm takes in adjusting to their respective environmental factors. Such factors are business strategies, market strategies, for example, new product development, technology, tax policies, and management practices. Disruptions may come from outside the family and business or from within them. So the disruptions that happen or come from outside the family and business are the external sources of disruption. And the ones that happen within the family and the business, they're internal sources of disruption, right? So these disruptions can either be good or bad, but nonetheless, a response from the family and the business is required. So as you can see here on the slide, there are a list of external sources of disruption and internal sources of disruption. So under external sources of disruption, you have economic upheavals. So for example, coronavirus would be a perfect example for an economic upheaval. After economic upheavals, you have technological innovation. So this could be the introduction of new equipment that can be used to make the process or the operations of the business run faster and smoothly. And last, you have the public policy changes. So if the government makes a policy change, for example, GCT should be 15% instead of 16.5%, that could be a disruption to the business. Under internal source of disruptions, you have marriage or divorce, birth, or death. So all of these contribute to the disruptions within a family and the business. As mentioned earlier, there should be a separation from the family and the business. Nonetheless, seeing that both parties are being engaged, there will be an overlap. That overlap represents where the family meets the business or where the business meets the family. So in this diagram, it shows just that, where the family and the business are separate. They have their separate resources and constraints, their processes and their achievements. And then in the middle, that shows where they overlap, right? And what is key is the sustainability of a business. So the sustainability of a business, it depends on the actions taken when these disruptions, as mentioned before, happen from both the family and the business without negatively impacting the success of the family or the business. Okay, so let's look closely at this diagram. So where the business and the family overlaps, you will see on your left the disruptions in family or business transactions, right? So from the disruptions that happen, as stated before, they would have to have a response. The family and the business would have to have a response to the disruptions in the family or the business transactions. And that response would then contribute to the sustainability of the business. Moving on to our next subtopic, forcing events. So forcing events are events which cause the replacement of the owner or the manager. So some examples of these events are illness or death of the owner. So the heir would immediately take control of the operations. Retirement of the owner or the manager. Legal issues which consist of incarceration or violation of the law. Example, CMU, maritime, that whole situation. And financial difficulties. So this is a result of lenders forcing the removal of the current manager or owner before lending funds to the firm. So forcing events are mostly unforeseen and unpredictable. So when these events arise, it can be difficult coming up with a solution, as the family does not necessarily have a fallback plan or a plan B or a contingent plan in place, which in turn creates problems for the business. Confusion, frustration, you name it. Even after these events are resolved and there is a successor in place, these circumstances influence the environment in which the successor will operate. This could affect the effectiveness of the successor to the business. That ends the segment of key factors to succession. Now, moving on, let's give a hearty welcome to Miss Cole, as she will be further informing you on the definition of an entrepreneurial successor and the sources of succession.
We'll now move on to sources of succession. So let's begin with who is an entrepreneurial successor. Now, the book describes such an individual as one who is high in ingenuity, one who is creative and also driven. The individual should also be able to provide the critical ideas for new product development and future ventures. In other words, one who is stable and capable of carrying on the business legacy. And as such, the entrepreneur may choose to look inside or outside of the organization to find such an individual to pass the baton on to, whether it be family or a non-family member. Let's get into the inside successor. The first inside successor we'll look at usually comes from the immediate family of the entrepreneur or the entrepreneur's next generation. The entrepreneur may choose to focus on his or her daughter, son, niece, or nephew for the passing of managerial controls, operational responsibilities, and eventually ownership. In this instance, the entrepreneur then becomes a coach and an advisor to the young heir. which in some instances may be challenging for the entrepreneur because of the attachment he or she would have had for the legacy built. Our next inside successor comes from within the organization. The entrepreneur would have had a trained team of executive managers, normally consisting of both his or her family members as well as non-family members. With personal training from the entrepreneur himself, his expectation is that within due time, a successor will emerge from the team, and that one day he or she will be able to hand the operations of the business into the hands of someone who has experience and knowledge of the day-to-day operations of the firm that he has built. So now that we're through with our inside successor, let's move on to our outside successor. Our first outside successor is a family member of the entrepreneur, which lies outside of the organization. The entrepreneur prefers for the family member to get his or her experience within another enterprise before assuming family business reign. Reasons behind this preference is that the entrepreneur hopes that while the family member is working in another enterprise, the family member will then make their initial mistakes. So when it is time to pass on ownership, they'll be prepared for the responsibilities at hand. Now, our last three outsiders are non-family that the entrepreneur may choose to hire. So we have our professional manager, our specialist, and assistant. An entrepreneur may seek to employ a professional manager as he is yet to find an immediate successor within the firm. But this is only for a period of time, so it's temporary. This is until an heir matures and shows that he is ready to take over the operations of the business. Second on the list of non-family outsiders is the specialist. This specialist has expertise with getting ventures out of financial difficulties. They are given full control by the entrepreneur and also the responsibility of handing the rejuvenated venture to a promising leader. The last outsider is an assistant. An entrepreneur may choose to hire an assistant if it is that no heir exists at all or that no family member that may seem fit for the position is interested in continuing the legacy of the entrepreneur. The assistant is brought into the venture with the understanding that he or she will be tasked with the responsibility of taking over the operations of the venture.
Mr. Abrahams will give a clear understanding of what it means to be in right standing with the law as it relates to discrimination in the workspace, nepotism, and more. Make him feel welcome.
All right, so legal regulations in regards to succession. The main focus here is going to be on nepotism, but before touching on that, we need to backtrack a bit to the Civil Rights Act of 1964. So the Civil Rights Act of 1964 prevents discrimination based on factors such as race, sex, religion, etc. And Title VII under this act forbids discrimination from an employer in regards to matters such as the conditions and the privileges of employment. It goes without saying that these regulations carry over into areas such as recruiting, hiring, promoting, and so on. So basically, the entire act is centered around equality in the workplace, which brings me to nepotism. If you aren't familiar with the term, essentially what it is when higher-ups give better treatment to their friends and family members in businesses. When it comes to matters of succession, the first source considered is oftentimes family members. However, extra care needs to be taken to ensure to avoid nepotism. Now, nepotism in and of itself isn't seen as discriminatory unless it has an adverse impact on women or the minority groups. So if there's a negative impact, it then becomes a case of discrimination, which is in violation of the Civil Rights Act of 1964. So we see how nepotism ties back into the whole Civil Rights Act of 1964. So in regards to succession, businesses would be unlawful to select someone purely based on family ties. This doesn't mean that a family member cannot be selected for succession. What it does mean is that this individual needs to be someone who is qualified, so as to avoid any talk of nepotism or breaking the law as it relates to discrimination.
I hope you are all following and being educated on the different criteria you'd have to take into consideration when implementing a succession strategy in your business. Pay close attention as Mr. Brown presents on the 3-step process in developing a succession strategy.
Developing a succession strategy. Developing a succession strategy involves 3 important steps. Number 1, understanding the contextual aspects. There are 5 aspects that must be considered for an effective succession: time, type of venture, capabilities of managers, the entrepreneur's vision, and environmental factors. The earlier the entrepreneurs begin to plan for a successor is the better chance of finding the right person. The prospects of events that force immediate action and result in adequate time to find the suitable replacement. The type of venture can determine how easily or not an entrepreneur can be replaced. An entrepreneur who is the decision maker in the business is hard to replace. For the capabilities of managers, the skills, desire, and abilities of the replacement will determine the future potential and direction of the enterprise. For the entrepreneur's vision, most entrepreneurs have expectations, hopes, and desire for their organization. A successor will share his or her vision, except in cases where the entrepreneur's plans have gotten the organization in trouble and a new vision is needed. Regarding environmental factors, successors are oftentimes needed because the business environment changes and a parallel change is needed at the top. The second step is identifying successor qualities. Successors should possess many qualities or characteristics. In some situations, some skills will be more important than others. The third step is a written succession strategy. Owner controls the management continuity strategy entirely. This is very common, yet legal advice is needed and recommended. The owner consults with selected family members. Here, the legal advisor helps to establish a liaison between family and owner in constructing the succession mechanism.
My colleague Ms. Blake, who is well known for her studies in exit strategy, will further explain the definition, the importance, the different types of exit strategies a business can take with the aid of a video on buy-sell agreements.
Every entrepreneur has a clear aim, and that is to create a successful company. But what will they do once they've achieved all the success they craved? This is where an exit strategy comes into play. An exit strategy is necessary to secure a business owner or an entrepreneur's financial future. It seems really strange to be planning to leave your business before you even get started, right? However, this is something entrepreneurs should do when preparing to launch a new company. Stay tuned to learn more about exit strategies, how important they are to an entrepreneur's future, how they relate to liquidation and investment, and the different types of exit strategies.
Here is just a definition of what an exit strategy is.
Establishing a solid exit strategy helps an entrepreneur to ensure a successful future. This is because the exit strategy gives the entrepreneur ways to liquidate or reduce their stake in a business, meaning closing off all business affairs and selling assets in order to pay off the business debts. And in the event that the business is successful, they make a profit. In the event that the business is unsuccessful, The exit strategy allows the entrepreneur to limit the amount of losses incurred in the business. Now, it is important to note that the way in which an exit strategy is planned doesn't only have an impact on the entrepreneur, but also it has an impact on management, other stakeholders, customers, consumers, investors, and it has a tax impact on their property, spouse, and family. The different types of exit strategies, which will all be discussed later on in the presentation, all offer different levels of liquidity. Liquidity in this case meaning how long will investors take to see their return, or how long will it take for the business to fully cash out. For example, an IPO would not be the best exit plan when there's a recession occurring. For example, right now with the coronavirus pandemic and its impact on the economy, it has caused asset prices to fall really fast, and businesses may end up not being able to fully cover their debt payments. And this will, in a sense, cause the business to make a loss. There are 3 types of exit strategies that are common amongst entrepreneurs today, namely buyer-sell agreements, acquisitions and mergers, and initial public offerings, otherwise known as IPOs. Buyer-sell agreements will be explained by means of a video, so please pay keen attention. Then I will come back and explain acquisition and mergers, and my colleague will explain initial public offering.
You and your business partner John run a successful business together. You are both experts in your industry and work well together, and each adds significant strategic value to the company. The unexpected happens and John passes away. The shares that used to belong to John are passed on to his spouse, Mary, who now has a 50% stake in the business. Mary has a different idea of how the business should run. You need to buy Mary out. But is she willing to sell? If she is willing to sell, what should the buyout value be based on? And how will you afford to purchase her shares of the company? This is where a properly drafted buy-sell agreement comes into place. The buy-sell agreement is established early when there are 1 or more partners in the company. It is a simple solution that ensures each business partner will have the right to buy out a deceased partner's shares from his or her estate and have the funds to make the purchase. Every business should have a plan to deal with the loss of its owners. A buy-sell agreement will ensure the continuity of your business.
Mergers and acquisitions. It is important to know that these are similar transactions and they are often brought about together. However, they are significantly different legal constructs. In an acquisition, both companies continue to exist as separate legal entities. However, one of the companies becomes the parent company of the other. Becoming a parent company means that one company owns enough voting stock to control another company's management and have influence over their board of directors. For example, in 2016, Walt Disney acquired Pixar for $7.4 billion, and they created movies such as Finding Dory and Toy Story 3, which are very popular movies. These companies together generated billions of dollars in revenue, and it is important to know that Disney became the parent company of Pixar. On the other hand, in a merger, both entities combine and only one continues to survive while the other company ceases to exist. For example, in 2015, H.J. Heinz and Kraft Foods merged together and created one company called the Kraft Heinz Company, which brought about household brands such as Capri Sun and Heinz tomato ketchup, gaining revenues of approximately $28 billion. And we can see the difference with this example in comparison to the former example, because Heinz and Kraft Foods together formed a totally different company, whereas Disney and Pixar are still different legal entities.
In our team, we have Mr. Ellis. He will be educating you all on initial public offering, mentioning and further explaining the initial public offering process.
My name is Daniel Ellis, and today I will explain what is an initial public offering and why it is an exit strategy. An initial public offering, also known as an IPO, is the process of offering shares of a private company to the public for the first time as a new stock issuance on a stock market. An IPO is an example of an exit strategy because it gives the owners of a company the opportunity to monetize their investments by selling their company on the public market. So there are several steps in the IPO process, and today we're only going to focus on 5 main steps. Step 1 is to present a proposal to the board. Step 2 is finding an underwriter and executing a letter of intent. Step 3 is to prepare a prospectus. Step 4 is pricing the offering. And step 5 is determining the offering size. So step 1, presenting the proposal to the board. This is the process of presenting the business plan and financial projection as to why the business should enter the public market to the board of directors. Step 2 is finding an underwriter. So the first thing is, what is an underwriter and what is a letter of intent? An underwriter is a financial institution such as an investment bank or accounting firms. 2 examples of underwriters in Jamaica are the Sagicor Bank and PricewaterhouseCoopers. An underwriter ensures that all the financial data is available to the public, and they also provide service of valuation to the company. A letter of intent is a document drafted between the company and the underwriter that spells out the terms and conditions by which the issuing company and the underwriter will conduct the IPO. So in this document, it would have the fee structures as well as the firm commitment by the underwriter. Step 3 is to prepare a prospectus. A prospectus is a marketing and legal document that the company uses to market its shares to the public. So there are a few information that must be included in the prospectus. So in the prospectus, it should have the history and nature of the company, the audited financial statements of the company, a brief description of the business of the company, the underwriting agreement, and information about the competition with an estimation of the chances of the company's survival. So step 4 and 5 is to price the offering as well as determine the offering size. The offering price is the per share value of a stock. So in this stage of the IPO process, the underwriter analyzes numerous factors when attempting to determining the ideal price per share. So some of the factors that an underwriter will take in regards to deciding what is the price per share is the financial performance of the company, the stock price of other comparable companies, and the general stock market. The underwriters will also consult with the managers of the company regarding the offering size based on what the companies wish to achieve from going
Well, I hope you answered those questions correctly and are enjoying our webinar workshop thus far. Our last objective will be covered by my colleagues, Miss Jarrett, informing you on the steps you can take in completing the sale of your business. Make them welcome.
Hello, good night.
Hey Alex, how you doing? Just calling to check up how you doing throughout this whole COVID time.
Boy, to be honest, no, lying, it's a mud me, I'm mud me. Tell them I'm mud me. Don't employ, I'm a customer, them I'm mud me too. By the way, you remember the business from my own tree?
Yeah, the SJP Auto Store?
Yeah, well, because of this COVID thing, that much of a story. Honestly, still don't know how to spell it. You know, it's a good thing to come to. Because I'm going to start a business, but I don't sell one. I do come and also you, it's bad, and the major and interrupting. Maybe you can help me with that.
Yeah, no problem. I feel like I remember some of the steps. I think the first step was that you need to prepare a financial analysis. So a financial analysis is used to analyze whether an entity is stable, solvent, liquid, or profitable enough to warrant a monetary investment. It is the process used to evaluate business projects, budgets, and other financially related transactions to determine their performance and suitability. Then you have to think about segregating your assets. To segregate your assets, you need to separate your assets from a larger group or create separate accounts for specific groups, assets, or individuals. If you were to get a tax accountant or even lawyers, they would suggest ways in which you could reduce these taxes. After that, you have to think about valuing the business. This is where you would need to get an appraisal of the business. A thorough valuation helps assure that the business is not underpriced and that the price is adequately supported. In this manner, this seller gains leverage in the transactions, right? Valuations draw on discounted cash flows, asset values, market price multiples, and other drivers which may be improved through management efforts. And one of the most important steps that you are clearly forgetting is to identify the appropriate timing. You have to sell the business while it shows a strong upward trend, or even better, timing would be to sell when the business is on an upward swing with potential buyers in the right mood and holding excess capitals or credit for acquisitions. So right now during COVID is not a good time to sell your business, sir.
Get you, So once all of this done, I'm ready. The next thing would be to publicize the offer to sell by preparing a prospectus, which will be reviewed by my bankers, accountants, lawyers, consultants, and my business brokers, so that the potential buyers can assess the business beforehand and decide how serious they are in regards to buying it. Remember learning it in a class though? And the next logical thing to do after that would be to finalize the prospective buyers and selecting the best candidates based on certain characteristics as well as their managerial reputation to evaluate if they are the best persons to buy a business. Because you know, I don't want to waste man, I want to store and things. So based on everything, it's only right for the next thing to do would be to remain involved through the closing. Because the change, that could be difficult, right? So meeting with a potential buyer could eliminate any areas of misunderstanding and negotiate requirements to not have my lawyer and my attorney with me. Because they're going to assist with the legal and the financial aspect of that. And when everything is done, I'm going to sell it. The last thing would be to communicate after the sale, because problems may occur between the new business owner and previous management staff. And you know, communication is key. Communication between the seller and the buyer could improve the day-to-day operation as well as the overall business. Anyways, it's a good thing to call myself. I will run through them steps here, because honestly, I never remember nothing.
Yeah, I mean, it's no problem at all. Anytime you need to talk or anything, we can always catch up. But I'm gonna run and try and get some of these chores that I have to do done. I'll catch you up on next time, alright?
Yeah, man, we'll link up that COVID thing.
Alright, later.
Thank you for joining us today. We hope this webinar was informative and you can now utilize these different strategies and concepts to improve your business succession strategy.